Smartest data, quick definitions, microeconomics. Let's get the video and take a look at why microeconomics is particularly important at the individual stock level. Let's go to the video. Microeconomic studies the decisions made or the potential impact due to incentives offered, probably the monetary or financial, in an economy. Thus, microeconomics analyse the potential implications and how economic elements are distributed and utilised. In economics, there are three and now probably a fourth resource, land, labour, capital, and now technology infrastructure, to consider. Microeconomics provides an understanding of an economy, the implications of incentives, and ultimately the choices made about the utilisation and distribution of resources. The participants, individuals or companies in an economy, demonstrate biases which occur when they make choices in response to incentives or changes in the offering. The incentives could be changes in prices or the availability of resources and improvements in production techniques. The various participants in an economy, buyers and sellers, are studied in microeconomics as they compete for resources or are in a competing supply and demand relationship of a resource. The economic tools of trade, money and the price of money, interest rates, become the conduit for barter or, more formally, negotiation. Thus, microeconomics looks at why participants utilise different economic elements and place different values on these elements. Ultimately, microeconomics studies the choices made by individuals and companies to allocate resources of production, exchange and consumption, then how participants benefit from efficient production, exchange, coordination and cooperation in an economy. In investing in stocks, microeconomics can assist in explaining the possible impact for an individual company. For example, if employment rights are legally changed, for example an increase in the minimum wage, this could have a negative impact on some companies. In closing, three quick bullet points regarding microeconomics. Microeconomics studies the choices made or possible impact due to incentives offered, for example, financial or monetary incentives. Then how economic elements are distributed and utilised in an economy based on these incentives. For example, resources, input resources into the production chain, so the cost of commodities, the cost of labour. In stock investing, it is critical to know how these economic elements can impact individual stocks, the sectors, or the overall stock market.